Gene Goldman, and today is Monday, December 5th. Here's a look at the week ahead. This week is going to be somewhat quiet, only a few major economic reports. On Friday, we get November Producer Price Index, and the consensus expects a continued downward trend. Also, Friday, we get December Consumer Confidence. Consensus also expects a flat data point relative to November. The Fed's going to be quiet. This is in advance of the next Fed FOMC meeting, which is on December 13th and 14th. So because of this, the Fed blackout period started just a couple days ago. So no Fed speeches, no Fed comments. So we have a lack of market moving data and no Fed speak. But with this in mind, let's use the opportunity to discuss corporate earnings. As I've said a few times in the past, the stock market likely will be led by two primary factors on a go-forward basis: Fed interest rate policy and the direction of corporate earnings. So if we go back to investing 101, corporate earnings tend to drive stock market price direction. So if earnings rise, for example, investors tend to be more optimistic about the stock market. So how are earnings looking for next year? So if you look at this table here, we grabbed data from FactSet as of December 3rd, so a few days ago. And this shows the estimated earnings growth for next year. So for each S&P 500 sector, the first column shows what estimated earnings were for the sector for next year back on September 30th, so a couple months ago. The second column shows what is estimated now for earnings for next year. So the big takeaway is that in less than 2 months, there's been a significant revision in earnings estimates. For example, look at the S&P 500. Back on September 30th, earnings were expected to rise 10% for next year. Now it's 5.7%. If you look at the first sector, communication services, back on September 30th, FactSet expected earnings to rise 23.6%. Today, it's 10.9% for next year. The major takeaway is that earnings are being revised lower for next year. This makes sense. Higher interest rates, higher borrowing costs, slowing economic growth, slowing inflation, which does reduce revenues. This could pressure stocks in the near term, especially as you see here, valuations are pretty high. The stock market could struggle. These struggles could continue into the first part of next year, especially if these pressures on earnings continue. Also, if we do have a recession, how bad will it be? Clearly, that will affect corporate earnings. The good news, our base case is that if we have a recession next year, it will be a mild one. Thank you for listening. For more information, please follow us on Twitter at SateraIM, and see you next week. Thank you.